Now, consumer inflation ticked up for the third consecutive month to 5.9% in October. The PPI print came in following the same trend, showing that manufacturers are also feeling the pinch, with producer prices rising 5.8% in the same period. Joining me now as we put the local inflation picture into perspective is Annabel Bishop, Chief Economist at Investec. Annabel, thanks so much for joining us today. Now, as mentioned, PPI accelerated to 5.8% on a year-on-year basis, 1% on a month-on-month basis, mainly in line with expectations. What camp are you on, Annabel? Did you expect the October PPI print to come in at these levels?
So I think, what the big problem is at the moment, we've obviously had, the last of the fuel price hikes coming through in October. And of course, November and December see fuel price cuts. And that's both diesel and, of course, petrol. Now, for producer price inflation, that's the cost of, manufacturing goods in South Africa. It's business costs. And, when diesel prices go up, they are felt quite substantially, as, of course, are petrol prices. And we think here of transport and all the factors of production that go into it. So, we certainly expect an increase. Perhaps we might have been a touch lower, but I think the bottom line is that going forwards, we might be able to see some moderation in the months of November and December.
So you definitely do believe that the acceleration will be short-lived, basically?
We do, unless, of course, there's any nasty surprises coming through. Look, the month of November is over already, but it's from an inflation point of view. But moving into December, there are always risks. I think, for South Africa overall, the inflation track was going to be bumpy, and that's what we see.
Earlier today, I read a note where an economist said that weaker domestic demand will limit firms' pricing power, which will in turn cap the extent to which they can pass these cost increases onto consumers. With that being said, do you expect to see this print and the few others that have come through with the acceleration in PPI being passed down to consumers at the till?
So I think, they have to, the cost increases have to be passed through because obviously they are part of the production. And, the bottom line really for South Africa is that we're often a price taker from a commodity perspective. When you think about our imported oil and petroleum products or, imported food, even for food that's produced in South Africa, and let's face it, the majority of the food that we consume is produced in South Africa. But of course, it's typically priced on international commodity prices. So when we see international commodity prices go up, then of course that has an effect on our food prices, particularly if the rand weakens at the same time. So these are our big risks. What happens to international prices, what happens to our currency, and of course, domestic demand is also quite key. When we are in a weaker demand period, obviously there's limitations to passing prices through, but then obviously when prices come down, then, and that's talking now, of course, about the cost of production. When it comes down, then obviously, that doesn't really come through in the tills, because if your producers have had to face higher costs of production, but been unable to pass them through, then quite, realistically, they can't pass through the lower costs either, because they come back to, a net zero. So this is really where we are in South Africa. Let's not forget the big problem we have as well, and that's the log jam at the ports. In fact, any problems at infrastructure cause a big issue in terms of pricing. It makes things more expensive. Costs are going up ports because of the log jam. Also, new infrastructure is needed. We also have issues in terms of electricity, and retailers, producers need to put in self-generation to help keep production and sales going when obviously we are in load shedding. So all of these factors contribute towards the cost of doing business in South Africa.
And I wanted to highlight those concerns, the backlogs at Transnet, load shedding, the volatile currency, as well as that the impact of those the weather conditions, the El Nino weather conditions that have hit the agricultural sector in particular, right?
Yes, and of course, the El Nino means below average rainfall for those of us who don't follow the weather very closely. And it is, of course, negative for crop production, for farming, and of course, when droughts get very bad, of course, also for animal production as well. We are luckily not in that situation yet. So we've come through a few years, about 3, if not more, years of La Nina, which just means above average rainfall. So because that really means we find ourselves in a situation where farmers will be able to ride out a few months of dry weather conditions at least. But we've also had quite good rains around the country. We're not really yet in the El Nino severe period. And also, of course, as well, I've been reading some articles saying the El Nino might only be for 1 year. Also, what's quite interesting is that climate change, which we know makes the world warmer, means that the air is a lot warmer, and warmer air means greater precipitation, more rain, can hold more moisture, and that also increases the rainfall capacity around the country. So I think worries about a drought, a severe drought this year, and the impact on food prices, they haven't really fed through yet into the actual experience yet. And of course, we're also hearing that it might be fairly short-lived.
All right, let's now look at the inflation picture as a whole while we take those risks into account. Yesterday's PPI print, the recent CPI print as well. Do you think that the SARB has inflation under control?
So I think it's very difficult for any central bank to get inflation under control when it's, obviously it's determined by so many factors. We've seen that with inflation in South Africa. Inflation dropped down towards 4.5%. Then recently it's just spiked right back up to 5.9%.
Yeah.
And here we're talking about consumer price inflation, which of course is our headline measure that our South African Reserve Bank targets. So around the world, we have seen a general downward trend in inflation, or disinflation, if you will, falling inflation. And of course, as we move into 2024, our expectation is that by the middle of the year, we will see inflation fall back to the 4.5% midpoint of the target range. So I think, the Reserve Bank does tend to look through a couple, 1 or 2 months of data that leaps up and leaps down again, because remember we also had some data leaping down to 4.5%, which excited some expectations of interest rate cuts earlier in the year. Looking forwards, we probably will see inflation fairly elevated in November and December, not as high as the October 5.9, but obviously, trying to come down, but not yet at 4.5. January, as we know, is the start of the year price increase period, and that could see inflation maybe move to around 6%. But after that, we should get back down, as I said, towards the 4.5%. And then in the second half of the year, we think inflation will actually dip below 4.5%. The South African Reserve Bank governor has actually said that he and of course the MPC committee want to see inflation anchored around the 4.5% mark before they cut interest rates. It just means we'll need to see several months of inflation at 4.5% or below 4.5% before the SARB looks to cut. And we're thinking now, because of this, they may only cut in September.
That does mean we'll see some relief for consumers going into the next year. Annabel, thanks so much for your time and those insights. That was Annabel Bishop, Chief Economist at Investec.